When I started my investment journey almost 20 years ago, I used to pick and choose individual stocks, investing in companies that I thought were going to go up. A lot of them did. Some of them absolutely went the opposite way and went down in a very big manner. That is when I started really researching and trying to understand index funds and mutual funds, which is what we're going to be going in this video today. So really, what is the difference between an index fund and a mutual fund? Why do a lot of people say, like myself, ETFs going into index funds? That is the only way I do my investing, while you have financial gurus like Dave Ramsey that always talks about mutual funds, always use mutual funds, and really understanding the difference between them will depend on the individual and how you are investing. Now, like I was saying, a lot of times I put money into individual companies, which back then it was actually through Investco, which I personally invested, putting a couple $1,000s, a couple $100s into a bunch of different companies. And again, it was very hard to know because we didn't have technology like we do today, exactly where and what to invest in. Then enters the low cost index funds. Then it enters the mutual funds. So interesting. Let's go ahead and break this down. Number one, an index fund can be a mutual fund. That is right. It might sound and seem very confusing, but a mutual fund is a pool of money from multiple sources to invest in a bucket of investments, usually managed by a manager, by an assessment or an asset manager. This is really the good way to think about it. So when you think of a mutual fund, you are pooling money together to essentially buy whatever is held within that fund that an asset manager feels should be invested into. This is one of the really big differences is when you look at an index fund and the funds that are actually allowed or that are built or made of that index, you could actually duplicate this in a mutual fund where someone manages it versus having the index. When you go through and mathematically you break out, the top 20 companies or top 500 companies of the S&P, you can put this together and build it yourself. But ultimately, this is where the human aspect comes in. Now that we'll touch on in a little bit. So how does an index fund differ from a mutual fund? Index fund is a pool of money that invests in a portfolio that tracks indexes. Now, most familiar like the S&P 500. The objective of an index fund is to mirror an investment or an allocation of the index that is chosen to mirror. So again, we see this with some of the index funds that we've covered through Vanguard, is they are looking to mirror the investments and allocation of a specific index. For instance, just to keep it basic, using the VOO, which is the Vanguard S&P 500, it is looking to mirror the S&P 500 with what they are invested in and how it is invested. So even if some of the companies within that S&P 500 change, the indexes are going to change as well. Now, big thing to note with this is indexes have a much lower expense. The reason being is when you're investing in an index fund, you are essentially putting money into an index. You are not having an individual. You are putting your money into one specific places where it says index funds can be roughly 10x lower than an average price mutual fund. Index funds can also give you better returns compared to a mutual fund because of the much lower cost structure that they do carry. So again, when we look at some of those Vanguard funds that have a 0.03%, the expense ratio on there, a 0.03, think about that. Most of the mutual funds are about 1%, if not more than 1%, to allocate into essentially fund that. So when you're thinking again of that 0.03 in comparison to a full 1%, that is a game-changing difference when it comes to the amount that is being eaten up in fees. Now, studies have also shown, and this is very interesting, investing in a low index fund fee compared to a higher fee mutual funds, more than 82% of mutual funds cannot outperform the S&P 500 index over the last 10 years. Let me say that one more time, guys. So you're paying for an index and the index fund is much cheaper, has a much lower expense. We know that across the board. When it comes to mutual funds are more expensive. They are managed by an individual. More than 82% of mutual funds have not outperformed or have underperformed the S&P 500 over the last 10 years. That is right. So there is only 18% of mutual fund managers that have outperformed the S&P 500 index in the last 10 years, which is kind of crazy to think that you're paying all of this money for an individual to manage these funds, and 82% of them, you would be better off just investing in that VOO, with the Vanguard S&P 500. Now, number three, they also do have very different themes. This is where the diversification of the portfolio, where an individual can kind of change this up, and the themes of indexes versus the themes of mutual funds. An index fund will track a very specific index of stocks. Now, we've seen this when we look at the technology, when we look at the growth, looking at the NASDAQ, the S&P 500, the Dow Jones. Depending on how you want to build these indexes, you can go ahead and you do those. Mutual funds may focus on a specific theme, such as emerging markets, growth stocks, which we know the Vanguard Growth Fund, things of that nature. So you can have kind of more specific what you're investing in, almost like picking individual stocks, but on a much larger scale on what that asset manager thinks that they are going to do. As we continue covering our investing advice, let me know in the comments what you guys think. Subscribe to the channel if you haven't yet, and let's continue with those differences between the index funds and the mutual funds. Now, of course, mutual funds are managed by professionals. This is really the big part of it, where the index fund, you don't have an individual that actually manages that index actively. Mutual funds you do, and that's what you pay for. So when you think of companies like Charles Schwab, they actually have money managers or professional money managers that will manage everything that you do for a fee. Actively managed funds, managers invest with a goal of beating the benchmark. That is usually set, usually like the S&P 500. Costs of actively managed funds are typically higher, giving the potential for outperformance. However, remember, 82% of them cannot beat the S&P 500. Most active fund managers are mutual funds, but there are many that are also indexed mutual funds as well, which is kind of crazy. And of course, the last one in this, which is again another big one, mutual fund experience capital gain distributions. So when it comes to taxation, this is a little bit different. Now, this is probably honestly the one biggest difference between having a person and having an index. One of the biggest differences between mutual funds and index is when a taxable event occurs for each one. First, we'll look at those mutual funds. Mutual funds experience capital gain distributions, which is a taxable event to the investor, even if the shareholder hasn't sold shares. That is right, guys. Even if you do not sell the investments that you are in, you could still experience capital gain distributions through those mutual funds. ETFs typically do not have this. Mutual funds are required to, by law, to make capital gain distributions to the shareholders. So they are going to be giving you a distribution for capital gains. Those capital gains are going to create a taxable event, meaning that if you have a really high distribution, that could affect your taxes that you file for the year following that, of course, that capital gain or that distribution that was given. Distribution represents the net gain from the sale of an asset or an investment throughout the year in the fund. Since ETFs are typically passive investments that track an index, investors typically do not realize any taxable event until they sell their investment. Again, this is a different way that kind of taxation is treated. So when you think of an ETF, there are passive investments that track an index. An investor does not recognize or typically does not recognize a gain until they sell that asset. That is the point where it is a taxable event, where if you have that a mutual fund with the capital gains distribution, you are going to experience a taxable event almost every year. If it's going to be a gain, I'm not sure on the flip side if it also includes if there is a loss, meaning that you could actually see a little bit of a tax break if you are taking losses on those mutual funds. But overall, if you're taking losses on the mutual funds, you're going to have to really examine who exactly your fund manager is, how exactly are they performing when it comes in relationship of the benchmark of the S&P 500. Now, of course, guys, for a lot of people who don't want to do their research, and this is where, again, personally, I kind of being in the financial sector and understanding exactly how it works. If you don't want to do your research, if you don't want to do your research on index funds, if you don't want to do your research on mutual funds, you know where to put them, where your money's going, exactly who you're putting your money into, this is the time that you're going to pony up the 1%, the 1.5%, whatever cost ratio it is. Find a financial advisor. Now, how exactly do you do this? Look locally. There are a ton of places online. I know Dave Ramsey recommends a lot of their financial advisors, but make sure you do all of your research. When you're going through and picking a financial advisor, It is a very strenuous, rigorous, really interviewing process. That is the best way to put it. I've worked with a lot of financial advisors through my years in both banks and credit unions. Some of them have done exceptionally well, some of them not so much based on performance. But overall, you have to find someone who has your kind of same thoughts, same ideas, same kind of forward thinking planning that you have, in yourself, and see exactly their track record, see what they're investing in. What does the outlook, kind of look like 5, 10 years? How long have they been with the company? A lot of interview questions that you can do in there to know the difference between those index funds and mutual funds. Definitely a really important part to really focus on. But of course, me personally, I prefer and I invest in those index funds because of the incredibly low cost ratio. And overall, the VOO, the VUG, a lot of those have done incredibly well. Now, I know the past performance doesn't really show what is going to happen in the future, but overall, very happy with the investment portfolio that I have. All right, let me know what you guys think about the index funds and the mutual funds, and I'll catch you in the next video.